Alright, let's get right into it. 10 signs that you're a smart, intelligent investor. The number one sign that you're a smart investor: you're willing to be lonely. We humans are biologically designed to live in tribes, closely knit communities. Without it, we wouldn't have survived. Within these tribes, we could pool our resources, share responsibilities, and protect each other from threats. Additionally, such social structure allowed for division of labor. Some individuals could focus on hunting and gathering, while others could focus on child raising and defense. Bottom line, it has been safe to belong to a tribe, and that is true to this day. No man is an island. However, where this can have negative consequence though, is when it comes to directing our investing habits. Given that we naturally follow the tribe, we also naturally follow what everyone else is doing when buying or selling in the market. When the market or stocks plummet, the average investor sees everyone panicking and follows the tribe by selling stocks and fleeing to the safe haven of cash. Or the other way around. When the market or a stock shoots up, the average investor sees everyone else around them making money. Thus, they follow the tribe and buy into the latest hot stock. But to win in the market, following the tribe blindly isn't the best strategy. It actually is the worst strategy. When the market is tanking, this is when we want to hold steady and stay invested in the market. And when everyone is making money in the stock market, this is when we want to be cautious. We all need strong communities and tribes to lead healthy lives. However, when it comes to investing, we have to be okay being lonely at times. You have to have the inner conviction that a lot of people do not have. You have to think for yourself. You have to be okay being lonely with your investment decisions. Smart investors don't get swayed by the tribe. Smart investors willingly take positions that everyone else don't think is too bright, buying and holding through a bear market. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. The number two sign that you're a smart investor: you manage your emotions well. If you turn on the news, you're bombarded with so many seemingly world-changing events: wars, political infighting, border tensions. In the world of financial markets, because it's so sensitive to these external events, behave very erratically and volatile, at least in the short term. So to stay in the market when it seems like the world is about to come to an end requires excellent management of emotion. Not to panic and do something you'll regret later, such as selling everything and putting all your money in your checking account. Managing our emotions in investing is one of the hardest things to do. It's not easy to have the fortitude to stay in the market when we see our portfolio drop by 30%. And it's not easy to stay out of buying certain stocks when we see our friends making easy money. We're all simple-minded beings. We get super optimistic when we make some money in the market, and we get super pessimistic when we lose some money in the market, emotionally reacting rather than following a logical investing strategy. At the end of the day, an emotional investor is not a good investor. Investing in general requires rational decision making based on sound analysis and long-term planning rather than short-term impulses. Thus, when you're good at managing your emotions, regardless of what life throws at you, you have the emotional discipline to follow the strategic, balanced approach to investment, having a long-term perspective and not letting your emotions take over the driver's seat. Between stimulus and response, there is a space. In that space is our power to choose our response. In our response lies our growth and our freedom. The number three sign that you're a smart investor: you only invest in things you understand. The financial industry loves to overcomplicate investing. Why? Because complexity creates an illusion of expertise. And when you can show a level of expertise, you can charge more. What do you think financial products have these crazy names like the callable reverse convertible notes, structured investment vehicles, or my favorite, non-recourse commercial mortgage-backed securities? You gotta admit, that was a mouthful. Only when you feel like financial professionals and institutions appear knowledgeable and indispensable in your wealth building journey would you be willing to pay an arm and a leg for their services. But you are a smart investor, so you don't easily fall for their tricks. You only invest in products you understand. Simple products that make sense. I say this in a lot of my videos, but the mechanics of investing in the market is not hard. If you invest in a simple broad market index fund that follows either the S&P 500 or the total market index, you're doing better than most people out there. These index funds are easy to understand, they're affordable, and investing in them is based on the basic principle that American companies will continue to provide value to their customers and thus in turn, profit to its investors. So don't get dazzled by the intricate array of investment products, strategies, and jargon financial professionals throw at you. They're doing that to make you feel like you need their professional guidance, reinforcing the industry's role and generating more business. All physical theories, their mathematical expression apart, out to lend themselves so simple, a description that even a child could understand them. In the spirit of financial products we actually understand, I want to introduce you to SoFi and their checking and high yield savings account. If you've been on the market for a great online banking option, I highly recommend you check out SoFi. Not only do they offer great rates, you pay no account fees, and you can earn up to $250 when you sign up and set up direct deposits. Of course, terms apply. Again, if you've been on the search for a great banking option, make sure to check out SoFi. And if you use my special link, which I'll have in the description below, you'll be supporting this channel as well, which I very much appreciate. Hopefully a win-win for all of us. Alright, with that said, let's get back to the video. The number 4 sign that you're a smart investor. Continuing from the earlier point, you're smart enough to understand what you're invested in, but also self-aware enough to know your knowledge boundaries. Smart investors know what they know, but more importantly, they know what they don't know. They know that their understanding of a subject has boundaries, and they know when they're approaching the limits of their competence. Bad investors don't admit their limits, or frankly, can't. They can't tell when they're crossing the boundary into things they don't understand. Thus, you have people spewing out why NFTs, crypto, or that tech company is the best buy ever. They read some Reddit forum thread or talk to someone who sounded like they knew what they were talking about and come to a conclusion that they now know. And they buy with this tiniest bit of information they scraped off from the bottom of the information barrel. The honest truth is that people that talk the most about a topic are often the ones that know the least. Really smart people understand what they know, but they know what they don't know. Thus, they listen more than they speak. They want to understand more, so they aim to expand their knowledge boundaries, rather than spewing out what they think they know. The number 5 sign that you're a smart investor. In the line of knowing your knowledge boundary, you also know that there is so much more that you don't know. More likely more than you know. If history is any indication of the future, everything is always in a state of constant flux. Economies, markets, industries, companies, and even our own lives. In the early 1900s, many investors were quite confident about the future, given the long period of growth the past several decades. In the aftermath of Civil War and Reconstruction, the American economy grew considerably as it entered the Second Industrial Revolution. Innovation in transportation such as roads, steamboats, and most notably railroads linked distant, previously isolated communities together, fueling globalization. Advancements in manufacturing and production technology made it easier to mass produce all kinds of goods, which in a way remade how we consume products. And all these progress allowed many individuals to build wealth. For a few, a lot of wealth. Andrew Carnegie, Henry Ford, John D. Rockefeller, and Cornelius Vanderbilt all came from this period. So if you grew up during these times, the future might have looked great. And if you're an investor, you are optimistic. However, what followed after, if you know anything about the first half of 20th century, quickly washed away any optimism. The assassination by a Bosnian revolutionary triggered a chain reaction that led to the outbreak of World War I in 1914. The New York Stock Exchange closed for 4 months, and every major European exchange shut down. The flu pandemic of 1918 to 19 soon followed and killed as many as 50 million people. Hyperinflation rampaged across Germany in 1922, allowing a man named Hitler to rise to power. The market crash of 1929 brought on the Great Depression. Then of course World War II from 1939 to 1945, which killed anywhere from 50 to 85 million people, mostly civilians. Could anyone basking in optimism in the early 1900s have predicted any of these events? 3 decades of chaos, war, and disaster? Smart investors like yourself understand that there is more out of your control than there is within your control. And you use this pragmatic worldview to your advantage. We can't demand a more favorable set of market conditions, but we can control our response. The number 6 sign that you're a smart investor. Because you're smart enough to know that you don't know, you're careful not to chase fads when it comes to investing. In 1814, Charles Mackay published a classic book titled The Extraordinary Popular Delusion and the Madness of Crowds, where he tells the history of crazy fads such as the Tulip Mania and the South Sea Bubble. The Tulip Mania is one of the most fascinating examples of an economic bubble where people follow the latest get-rich-quick schemes. In the early 17th century, speculators from all walks of life bought and sold tulip bulbs and had even declared future contracts on them. Supposedly, some tulip bulbs actually became the most expensive objects in the world during 1637. Kinda reminds you of the recent rise of cryptocurrencies and NFTs, right? Smart investors like yourself know that when there is so much attention towards certain get-rich-quick schemes, companies, or even assets, you know you need to proceed with caution. Bottom line, don't chase fads. The number 7 sign that you're a smart investor. So in the face of truth that there is so much we don't know, what can we do? You embrace diversification. You understand and fully embrace the power of diversification when it comes to investing. There are investors who do really well. You might have heard of a few of them. Warren Buffett, Peter Lynch, Benjamin Graham, Sir John Templeton, Thomas Rowe Price. They are so famous that books have been written about them, buildings have been named after them, and companies are built bearing their name. Why? Because beating the market is so difficult, and those who can do it well are as rare as unicorns. And many of them will even admit that they get it wrong more than they get it right. I've made plenty of mistakes, and I'll make plenty more mistakes too. So what hope is there for the rest of us mortals who don't have Warren Buffett or Peter Lynch's brain? Diversify. Don't try to pick winning stocks. Don't try to pick winning mutual funds. Invest in a simple, broad market index fund that represents a large part of the stock market. Don't put all your money with any one expert. Don't put all your money in any one industry or any one nation. Nobody is that smart. So the wise thing is to diversify. The number 8 sign that you're a smart investor. Continuing in the line of diversification, you understand the power of patience. You mitigate a huge risk of investing by diversifying as much as possible. However, if you want to really grow your investment, you have to give it time. You can't expect to double your money overnight, over a month, or even within a couple of years. You have to give it decades, allowing the power of compounding to work its magic. In 1626, a Dutch colonist named Peter Minuit arrived in present-day Manhattan, New York. He was hired by the Dutch West India Company to oversee its colonizing activities. Whether by luck or some savviness, he was able to purchase the island of Manhattan from the Native Americans in exchange for the traded goods equivalent to $24. Yes, Peter Minuit got a great deal because Manhattan is worth way more than $24 today. However, what would have happened if the Native Americans had invested this small amount of money at 8% a year? $24 compounded over 397 years at 8%. It comes out to crazy $446 trillion. To put that in perspective, the entire world's GDP is $88 trillion. I know what you're thinking. An investment that could return 8% a year for 400 years did not exist back then. However, what I'm trying to convey here is the power of time. How do we turn $24 to $446 trillion? Time. While a diversified investment reduces risk, the real secret sauce to multiplying our investment is time, and thus patience on the part of the investors. Smart investors don't quickly change from one fund to another. They don't pull out their money and try to time for the right buy. And they don't easily change investment firms because a new firm is advertising a fund that is 0.01% cheaper. Smart investors are patient because they know that even an average fund with average returns held for a long period of time will give them great investment growth. The number 9 sign that you're a smart investor. You understand the power of simplicity. As stated earlier, the financial industry loves to overcomplicate finance and investing, and simple doesn't get the attention and the praise that it deserves. Josh Waitzkin, an expert on peak performance, talks about in his book, The Art of Learning, An Inner Journey to Optimal Performance, the importance of breaking down complicated challenges into simple components. For example, when teaching chess, he will remove all but 3 pieces, 2 kings and 1 pawn, as a way of exploring the game's essential principle in its simplest form. When teaching Tai Chi, he would obsess over the simplest of movements, simple motions, not the complex techniques. It is rarely a mysterious technique that drives us to the top, but rather a profound mastery of what may well be basic skill set. In the same way, smart investors understand that they don't need a fancy, intricate investment strategy. Just a strategy good enough to achieve our financial goals. And most often, a simple investment strategy will do that and more because not only do we understand it, its simplicity keeps us going even during the most turbulent times. Even Warren Buffett is a grand master of simplification. In 1977, he wrote in his shareholder letter 4 criteria for selecting any stock. We want the business to be one that we can understand, with favorable long-term prospects, operated by honest and competent people, and available at a very attractive price. This simple principle has enabled Berkshire Hathaway to be one of the most valuable companies in the world today. And if Warren Buffett, one of the richest men in the world, believes in simple investing, we should follow suit. The number 10 sign that you're a smart investor, and my personal favorite, you are humble. You are smart enough to be a good investor, however, you're also humble enough to know that there is a lot of luck involved in your success, keeping your success from getting to your head. In the book Outliers by Malcolm Gladwell, he makes the argument that many people's success is not solely determined by talent and hard work. Rather, external factors such as family background and culture all play a significant role in shaping a person's life trajectory. Malcolm points to the success of Beatles and their Hamburg Crucible as one of those examples. At the beginning of their band career, the Beatles were given opportunities to perform regular concerts in Germany. On surface, this may not sound that different from any other band that were given opportunities to play. But what set the Beatles apart was the frequency. The Beatles ended up traveling to Hamburg 5 times between 1960 and the end of 1962. On the first trip, they played 106 nights, 5 hours or more a night. On their second trip, they played 92 times. On their third trip, they played 48 times for a total of 172 hours on stage. The last 2 gigs in November and December 1962 involved another 90 hours of performance. In total, they performed for 270 nights in just over a year and a half. Thus, by the time they had their first success in 1964, they had performed live an estimated 1,200 times. Most bands don't get the opportunity to perform 1,200 times in their entire career. So what does Beatles playing in Germany have to do with humility? I like to compare it to the opportunity that many of us often take for granted. If we're fortunate enough to live in a stable country, have the opportunity to make good income, and also invest in good market, these are our Hamburg Crucible. Yes, we have to work for it, but these are life opportunities that many are not afforded. Smart investors like yourself understand this fact. Therefore, you're thankful and you're humble. Thank you guys for watching. In the line of investing, if you want to know how to maximize your investment portfolio for maximum growth, please check out my video here. Until next time, my friends, Financial Tortoise signing off.